Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500, and today is Estee Lauder Companies, ticker EL. Over the next few minutes, I'll discuss my thoughts on both valuation of this company and its business quality. First up, we have a market cap of $86 billion, enterprise value of $88 billion. You see about $2 billion in net debt on this business, which is basically very, very little when you look at the total market cap here. You're talking about maybe 2 to 3% of the business. It's a very small amount, so it's basically immaterial to our analysis. The industry is in the personal products industry. The business description tells us that Estee Lauder manufactures skincare, makeup, fragrance, and hair care products worldwide. What's significant about that is that beauty products in general, and especially these markets, tend to be very high gross profit margins that can be the sign of a potentially very good business if they're backed up by brands. And it looks like they do have quite a number of brands. You can see here that they have the Estee Lauder, Aramis, Clinique, Lab Series, Origins, MAC, Bobbi Brown, La Mer, Aveda, Bumble and Bumble, Darphin, Smashbox, etc., etc., etc. They have all these different brands. Very, very good to have brands you can sell under, because what you're doing with skincare, makeup, fragrances is you're selling something for much higher than its input costs. And the way you do that is through branding, advertising, and building that connection with your consumer. And so that's a very good business to be in if you can reach scale. Now, and of course, at $88 billion, they probably are reaching a very good scale. When we look at our return on invested capital chart, a few things immediately jump out to me. The first thing that's instantly visible is you have 20 straight years of profits. Anytime you have 20 straight years of profits without a single loss, you're talking about a very good company. That's a good start for a high-quality business. The next thing that's really interesting is that you do have cycles here. It is cyclical to a degree. You're not having very steady earnings from year to year, but the cycle bottoms are not bad. Look at that. They have 3 cycle bottoms in the last 2 decades. In 2006, you had a 10.5% return on invested capital. 2009, a 7% return on invested capital. In 2020, a 6% return on invested capital. Of course, you think about this, the only times the return on invested capital dropped below 10% was 2009, the financial crisis, and 2020 with COVID. Both of those are very large distortions in the market, and otherwise they're earning very strong returns in the high teens. You see 17%, 17%, 19%, 18%, 15%. They get above 20% for 5 years in a row from 2012 to 2016. Again, above 20% 2019 and 2021. Very strong 15% plus return on invested capital. I'm really attracted to these numbers that I have here. Very strong setup for a high quality business. You see these high gross profit margins that I mentioned, 80% range. Now, they're not turning that into super high free cash flow margins, but still 11-15% are very good numbers. Now, what I like to see here that just really hits this towards potentially being a watchlist company is these 10-year median returns. Now, it was foreshadowed with our analysis here. You see a 20% average return on invested capital. My minimum is 10%. And yet we're hitting 20% here return on invested capital. My minimum for return on equity is 15%. Yet you're at 32%. You're basically doubling my hurdle rates here with this company. So it's very, very attractive numbers. I love what I'm seeing here. Very high quality business. In addition, you can see that they're combining this high quality business with a relatively strong growth. While they're not growing revenue at double digits, they are growing their free cash flow and EPS at double digits, and that can be very attractive. Now, the only part that I'm less happy about is that they're growing their assets substantially faster than their revenue, but fortunately, they're keeping asset growth in line with EPS growth, which is an acceptable setup to have over the long term. You're not going to have a lot of negative operating leverage as long as you can keep these relatively close in line with each other. But usually when your assets are growing faster than these other metrics, then it's going to have decreasing returns on invested capital over time. You have seen that because about 10 years ago, you were above 20%. Now you're about 15, 16%. Either way, these are all very, very good numbers. So it's not like that is a problem at these ratios. The first main problem that I would have with this company really comes down to valuation. You see the PE ratio here of nearly 40. The problem is, I can see this as a high quality company, and clearly the market does as well. When you have a PE like this, the market's able to identify that this is a high quality company, and so they're pricing it at a very high rate. So the first thing that I do when I see a high PE ratio like this, high valuation, is I'm checking against these other ratios. Do they seem like they're out of whack? And no, a high price to book, a high price to sales, high EV to sales, high EV to EBITDA. So most likely the earnings number here, because it's price divided by earnings, isn't a one-off low number. And we can see that when we look here. You see 2022 was lower than 2021, $6.55, but that's higher than every year before it. And so it's not a one-off low number. Like if this was a $2 number, then I'd start to be concerned, well, maybe this PE ratio is off. But the PE ratio is probably accurately determining what you have here in terms of the valuation, which is to say that the company is very highly valued, very highly priced. I like to buy companies with a PE of 15 or less. Even high-quality companies, you can sometimes find a PE of 15 or less. But for high-quality companies like this, something like a PE of 20 can be reasonably justified. A PE of 40 becomes very hard to justify. You're not growing at 30% a year. You're not growing at 20% a year. You're growing at 12% a year. And at 12% a year, paying a PE of 40 is not likely to work out super well over the long term. This is turning me towards making this a watchlist stock versus a current buy, but that's still very valuable to find companies that are very attractive on the metrics over the long term. Now, what we can see, though, if you just look at EPS, though, some of the things that are really attractive, once you get in this 12% EPS range, this is what you're going to see. You have a $2.58 EPS, and you're basically tripling to $7.50 range over the course of a decade. Anytime you triple your earnings over the course of a decade, you're setting up to outperform the S&P 500, and that's a very good metric to hit. Not only are you growing at that rate, you've paid a dividend every year for the last decade, and the fact that you're able to pay a dividend and still grow at that rate means your returns are going to be even better than that looks like on the first pass. If you're enjoying this video so far and you're a long-time listener, hit that like button. If you're new, please subscribe. Your subscriptions and your likes help to tell YouTube that you're enjoying my content. So let's go to the income statement. Again, just instantly on the income statement, you see this big gap between revenue, cost of goods sold. 80% margins there are just phenomenal in terms of what they can do for the balance. The way that your incomes works as you grow that revenue. You grew the revenue by 70% here, and yet your pre-tax income basically doubled. And so that's or more than doubled. So your pre-tax income more than doubled while you only grew your revenue 70%. Why is that? Well, your high gross profit margins and some cost control here on the SG&A line are allowing your operating profit to grow much faster than your revenue. That's a really nice setup for operating leverage. I always like to see that as a shareholder. Likewise, your net income does even better. $1 billion here, you're at $2.5 billion. Basically you've doubled over the course of a decade, but your EPS is doing even better than that because you have bought back shares over time. Again, when you have these high quality companies, a lot of this stuff tends to go together and combine to really set you up well. Here we see they're basically retired about 10% of the shares outstanding over the last decade, which is going to add about a 1% per year increase to your investment on an EPS basis. It's not a ton, but any sort of buybacks are really helpful for you as a shareholder in your long-term returns, especially if you hold this for decades and decades, which you would like to do with high-quality companies. So if we go to look at the balance sheet, let's see PP&E. So here's something that's really interesting. So you have $1.2 billion in PP&E. You have grown this very quickly. We said you're growing your PP&E quick. You've basically 3 to 4x your PP&E. But if we look at this, you have $4.5 billion in basically your tangible, PP&E assets. You have a lot of goodwill here. You have intangible assets, but like $4.5 billion, and yet you're earning an operating profit of 3.2. Pre-tax income of 2.7. So you're talking about like 50% returns on that tangible PP&E. Now you are having to hold some inventory, accounts receivable. So there are some other assets here. It's not as simple as that. But like those are the things that go into these really strong return on invested capital numbers. You don't get numbers like this unless you're able to turn these tangible assets into very, very profitable results. And so you really like to see that. Accounts. Let's see, long-term debt here. So if we look at our debt, you have grown your debt in a similar amount. But what I like here is your long-term debt is $1 billion. Long-term debt is $5 billion here at the end of the decade. You're basically matching your debt against your PP&E which is a very safe way of managing it. You're not having a substantial more debt. You don't have more debt, basically covering goodwill and intangible assets. Your debt's really focused on covering these tangible assets. It just sets up a better balance sheet for you overall. Requires you to use a little bit less shareholder equity than you otherwise would. That's a nice setup to see. You see these returned earnings kind of growing over time, retained earnings, as they build that into the business. Treasury stock. So that's where they're putting those buybacks, which we should see in the cash flow statement. So you see here, they have bought back shares every single year, which you really like to see that. So constant buybacks, growing buybacks, putting a significant portion of your cash flow from operations into buybacks. They're also paying quite a bit of dividends. And what you like here is this cash flow from operations is able to cover your PP&E and your buybacks. It's not like some of the ones I look at that are almost like Ponzi-like, where you need that to be taking on debt in order to fund your cash flows. You're not having to do that here. It's a really nice setup that they have in terms of that. What I don't like as much is you have a very high component of stock-based compensation. I don't really know why a beauty company needs stock-based compensation to this degree. I mean, the problem with the GAAP stock-based compensation numbers, you see 150 million here, 300 million here, is that's going to understate the overall cost of the stock-based compensation. You're spending a significant amount of money buying back stock. So look, 388, 146, so you're over double the number that you have here, stock-based compensation, but it's not going to cause as much reduction in the share count as you would expect, because you should inherently think like this number is 2 to 3 times bigger than it shows here, just due to how the accounting works. And so it's going to require a much higher buyback cost to offset this, especially when you trade at a high PE ratio. Those GAAP accounting metrics are going to get even worse, because a lot of times the way that these option pricings work is it just makes it a tough setup for you to get a good return as a shareholder. It just means that when you're doing substantial buybacks at high valuation ratios, the return to shareholders are going to be worse than they otherwise would, which is less appealing. I don't have a problem with them using the money that way, because it allows investors to decide for themselves when the stock is cheap, when the stock's not. But it doesn't mean is when the stock is expensive, those are going to be less effective buybacks. So, Estee Lauder. For me, this would be a watchlist company. Anytime I see this 20 straight years of profits with high returns on invested capital, high gross margins, high growth rates, I get attracted. That's what should make it on my watch list. I like that even though it's cyclical, the bottoms of the cycles are still substantially profitable. 7% returns, 6% returns in 2020. Basically there's only 2 years at the very bottom of recessions that you were below a 10% return on invested capital. And that's a very strong metric to get on my watch list. And then also, like, during a normal year, they're running 20% plus returns on equity, 30% plus returns on equity. Very strong numbers. They are growing in the double digits, which is a big plus for getting on the watch list. For me, it's just the current valuation's a little high. I'd like the price to be about half what it is for me to get super interested. Something like the $120 range starts to get more interesting for me as a potential shareholder. But that's what a watch list is for. You put it on the watch list. You can come back to it later when the price gets more attractive. Thanks for listening. Until next time, stop paying fees, start building wealth. Please like and subscribe.